Hi, I'm Professor Crawford, and this morning we're going to continue with our discussion about beginning financial accounting processes. Last time we met, our intent, our goal is to tell a story about what happens to companies when they make decisions. Those decisions are evidenced by what we call business transactions. And those business transactions need to be accurately reported or captured on the records of a company. So we start the process by examining these transactions, what happened, and ultimately the impact. And as we said yesterday, every business transaction must impact at least two accounts. There are only 7 possible outcomes. Either assets go up or down. If an asset goes up, a liability or an equity account must go down. Or if you don't do anything to an asset, then the equity and the liabilities have to continue to balance. Everything we do in accounting is always predicated on what is called the accounting equation. Total assets, the good guys, the future value, is always going to equal the total debt or the liabilities of a company, plus what the owners have in value in that company. So assets, really, when we think of them, there are 2 groups that have claims on the assets. You have the creditors. Those are the people that lent the company money, and therefore they must be repaid. And then after the creditors are satisfied, after you have paid all of your liabilities, everything else belongs to the owners. In a small company, in a sole proprietorship, for example, a small business, that is called owner's equity. In the corporate form of business, we call that equity. We also discussed yesterday that when we analyze transactions, not only do we have to identify the accounts and what happened, but also whether or not we are debiting or crediting. Because when we begin to write down what happened, we record in what we call the journal, the book of original entry. And journal entries are always debit and credit format. Debit, whenever an asset goes up, whenever a liability goes down, or whenever your net worth goes down. Net worth goes down generally 2 times. When you have an expense, and when you pay out profit to the owners. A drawing in a small business, a dividend in a corporation. Credits. Credits reduce assets, increase debt or liability, and increase net worth. And again, there are 2 times that net worth is increased. That's when the owner makes an investment and when we generate revenue. So after we're done making those decisions, we then go to the journal and we record the account that's being debited first and followed by the account being credited on the next line. We always indent the account being credited. We're always keeping in mind the accounting equation, always maintaining that equality. Once you're done with the journal entry, which shows the global or the big picture, we then go to the ledgers, and that's where we show the individual impact of a business decision on individual accounts. Every asset, every liability, every owner's equity or stockholder's equity account has their own individual ledger. We keep the asset accounts together in the ledger, then we go to the liability accounts, and then finally the equity. We call that posting, or transferring information from the journal to the ledger. You've already made up your mind. You've already made your decisions. So you're merely transferring or posting the same information. So if you debited an asset in the journal, debit that same asset in the ledger. If you credit a liability in the journal, credit the same liability in the ledger. At the end of a time period, usually a month, we want to check to make sure that we didn't make a mathematical error, maybe forget to post something, put something on the debit side when it really goes on to the credit side, and we then prepare what is called a trial balance. And all a trial balance is, literally, is you take all of the balances in your ledgers. You're going to list all of your assets and their corresponding debit balances. Then you're going to list all the liabilities and their corresponding credit balances. And then finally, you'll get to your equity accounts. And remember, equity, I call them my blended family. Some equity balances will have credit and some will have debit. The credit balances will be the owner's capital in a small business, common stock in a corporation, and revenue always has credit. The debits will always be expenses and drawing in a small business or dividend in a corporation. And we expect in the trial balance that every account that has a debit balance equals all the accounts with the credits. Now you're good to go. You know you didn't make any errors in mathematics. Unfortunately, if you misinterpret the business transaction in step 1, we tend just to carry that error through. So you can get a trial balance to equal, but it doesn't necessarily mean you did it right. But at least your debits and credits equal. All right. What is the next step? The next step in the accounting cycle is to go through what is called the adjustments. We need to adjust our accounts to make sure that every asset, liability, revenue, and expense has the correct balance. So there are different types of adjustments that we're going to do. Okay, we're going to review them now. The first category of adjustments is called prepaid adjustments. What do we mean by that? We mean that there are accounts that are currently sitting in the ledger as assets, which perhaps, because of either wear and tear, time, or usage, have become expenses. So that's the purpose of prepaid adjustments. We want to convert assets into expenses. We need to convert assets into expenses. So, not all assets, but some assets are going to become expenses, and it's not going to happen automatically. We need to kind of tweak those accounts to make sure that when we ultimately prepare the financial statements, that we don't have assets recorded on the balance sheet that actually belong on the income statement as expenses. So our prepaid adjustments, and they fall into 3 categories. We're going to adjust for supplies. We're going to adjust for prepaid expenses. Most commonly, we see rent or insurance. And finally, we're going to adjust for depreciation. Those are the 3 areas of prepaid adjustments that we take a look at. So let's first look at supplies. What happens in a company is they call up, and today everyone orders online, and they order supplies. And the purpose of the supplies is to use them in the operation of your business. And so that's what makes them initially what we would define as an asset. Remember, by definition, all assets must have future value. So I buy my supplies, whatever they may be. So let's pretend we bought a whole bunch of supplies. We've got a whole bunch of markers. So when we first purchase those supplies, we would record them as assets. So for example, if we were to look at the ledger for supplies, DR stands for debit, CR stands for credit. We would initially record the amount on the debit side. Go from the journal to the ledger. So let's pretend we acquired $10,000 worth of markers. You're going to debit supplies initially, and you'll credit either cash if you paid for it immediately, or accounts payable if you're going to pay for it in the future. Time passes. Let's pretend we purchased these supplies on January 1st, 2014. As time passes, your employees, your company, is going to use the supplies. As the supplies are used, they become expenses. So one way of looking at an expense is to say it represents a used up asset. And so what companies do when it's time to prepare financial statements is they go back and they revisit, for example, supplies. They say, all right, we started with $10,000 in markers. Now I open my supply cabinet. I look at the amount that remains, the amount of markers I haven't yet used. And let's pretend that when we open the markers, we started out with 10,000 and we've used up, and now there's only 2,000 in supplies remaining. Started with 10, we have 2 left. So the difference between the $10,000 that we started with and the $2,000 that remains will become our adjustment. So the adjust record, we're referring to the journal. You're going to record your adjustments in the journal. So we're going to take it out of the asset and put it into the expense. So the entry, the adjustment, will be a debit to supplies expense for the supplies used up. And we will credit the asset supplies. So that is the first type of adjustment that falls under prepaid. And so what will happen is our asset supplies will go down, and it becomes an expense. What would remain in our asset supplies ledger would be the $2,000 worth of supplies we still have. What does that mean? We are still accounting for the original $10,000 we spent on supplies. But now, 8,000 of those costs will be reported on the income statement as a deduction from revenue. And only 2,000 will remain on the balance sheet as an asset. So we always have to make sure that we account for the total cost, what we have incurred as a cost, what we paid in value for those supplies. $10,000 was expended. Where is that $10,000 being reported now? $8,000 is going to the income statement as a deduction, and $2,000 remains as an asset on the balance sheet. So companies every quarter, some companies do it every month, will adjust accounts because you want to make sure all the balances are accurate before you prepare your financial statements. So that's the first type of prepaid. Next, we're going to go to prepaid expenses. So on occasion, companies will prepay an expense. Maybe they'll prepay their rent. Many times that is a requirement of an insurance policy. They want the premium paid in advance. So anytime you pay something in advance, once again, it provides us with the opportunity to receive benefit in the future. So the prepayment is what allows us to initially record that as an asset. So let's pretend we have the same company, and what they did is they prepaid their rent in advance 6 months, and they prepaid $24,000 in total. $24,000 over a 6-month period would mean the monthly rent is $4,000. Okay? So on January 1st, they would record the transaction by debiting prepaid rent, asset, and once again, they're either going to credit cash if they paid for it, which I would assume they did. Every single month, we have to take it out of the asset account called prepaid rent and put it into the expense account called rent expense. And so that would be our adjustment. Again, we always go to the journal. And our entry would be a debit to rent expense every month, $4,000. And we're going to credit the asset prepaid rent, $4,000. So again, what we would see in the ledger when we post it is the rent expense going up and the asset going down. So at the end of January, when we start February 1st, that's what would remain in prepaid rent. So every single month, we're going to take $4,000 from the asset, called prepaid rent, and transfer it into the expense. With supplies, we use them. With prepaid rent, it's an element of time. As time passes, it goes from the asset into the expense. You can almost literally think about pulling the pages off of the calendar. As January and we pull the page off the calendar, we have to remember, I need to adjust. I need to take $4,000 from my asset account and put it into my expense account. Okay, so remember, credits are always reducing assets. The third and final type of prepaid adjustment is for depreciation. What we see with depreciation is we will have property, plant, and equipment, building, machinery, furniture, fixture, automobiles, trucks. Every item that falls under the property, plant, and equipment category, which we call non-current asset, except land, depreciates. What do we mean by depreciation? We mean we are going to take the total cost of that asset. How much did we spend in cost on the car, on the equipment, on the building? And we're going to recognize that cost throughout the asset's what we refer to useful life. What's the time period that the company is expected to receive benefit? So let's pretend we acquire a truck and we pay $25,000 for the truck. And the plan is we're going to use that truck for 5 years. And one of the most popular depreciation methods is called straight line depreciation. Simple. We calculate the amount that we're going to depreciate the truck by once, and every year we would take 1/5 of that $25,000 and write it off or recognize it as depreciation. All right, so we would take our $25,000 cost. We would write it off over 5 years, and the depreciation amount each year would be $5,000. I'm going to keep it simple. We're not going to talk about salvage value. That's going to be in a more advanced class. And so once again, in our ledger, we would see an asset called truck. And when we initially purchased that asset, we would record that $25,000. Now, long-term assets, property, plant, and equipment, always remain on our books, in our ledgers, at what we call their historical cost. So we're going to leave the truck on the books at $25,000. Unlike what we did with supplies. With supplies, we reduced that asset. And with prepaid rent, we reduced the asset. We're not going to do that here. Instead, we're going to use what is called a contra asset called accumulated depreciation. Depreciation amounts every year in the accumulated depreciation. And what we'll see on a balance sheet, for example, is we'll see the cost of that asset, $25,000, and then we're going to deduct from that asset the balance in the accumulated depreciation account, that contra asset account, and that will provide us with the remaining value, which we call the book value. And so what we would again record in our journal would be our adjustment. Once again, we're going to debit an expense called, in this instance, depreciation expense, $5,000. But instead of crediting the truck, we're going to credit the contra asset account called accumulated depreciation. So every single year, that accumulated depreciation balance is going to go up, and the book value is going to go down. Okay, so depreciation expense. We still record that in our ledger as a debit, but now the credit goes there. $25,000 less $5,000 gives us our remaining book value of $20,000. So every year, the accumulated depreciation balance will go up by $5,000. Every year, the book value goes down $5,000. So those are the three types of adjustments that fall under the prepaid category. We adjust for supplies as we use them up, debit supplies expense, credit the asset supplies. As we have prepaid rent, as time passes, becomes an expense, debit the rent expense, credit the asset prepaid expense. And finally, the third item that falls under adjustments for prepaids is for depreciation, debit depreciation expense. And now, don't credit the asset, credit the contra asset called accumulated depreciation. And if we want to determine what we refer to as the book value, it will be the difference between the cost of the truck, $25,000, less the accumulated depreciation of 5 or 20. Okay, that's only the first type of adjustment. The others are simpler because we don't have 3 items, we'll only have 1. All right. After we're done adjusting our prepaids, we're next going to move to what is called unearned revenue adjustments. Now, not every company has unearned revenue. What do we mean by unearned revenue? We mean revenue that we collected before we earned it, unearned. All right, so A was prepaids. We did that. Now we're going to move to B, unearned revenue. All right. Unearned revenue. Sporting teams, concert promoters, magazines, and any company that offers gift certificates will have unearned revenue. Unearned revenue means the company receives the cash before they've earned the revenue. Before the revenue is earned. All right. What is unearned revenue, therefore? Unearned revenue is initially recorded as a liability. You're going to debit your cash because you have the cash, but what goes on the other side of the entry would be a credit to unearned revenue. Now, why is unearned revenue considered a liability? It's considered a liability because if the sporting team doesn't play the game, they've got to send the fans their money back. If the person who's supposed to perform the concert doesn't appear, concert promoter has to send the money back. If anything that is promised to happen in the future doesn't, there's a liability for that money to be returned. So let's pretend we're the New York Yankees, okay? And we've collected in advance unearned revenue. Could be any sporting team. And because it is a liability, the expectation is for the entry to be on the credit side, and we increase it. So let's pretend we're the Yankees, and we collected in advance $100,000 for tickets to our games. Clearly, it's going to be a lot more than that, but we want to keep it basic. So let's pretend we've collected that for 5 games. So every time the Yankees play a game, a portion of that $100,000 will no longer be unearned, it will become earned. All right, so after they play the first game, we will record an adjustment for the revenue that we've earned. So if it's 5 games, $100,000, every time we play a game, we're going to debit and reduce the liability unearned revenue, and we're going to put it into the revenue account. Liability down, revenue up. Yay, that's a win-win. Liability down, revenue up. So it's going to go from the unearned revenue account to the revenue. So if it's the Yankees, it'll be baseball revenue. So our entry would be a debit, which is reducing the liability, $20,000, and we'll credit the revenue, $20,000. So now the Yankees only have $80,000 remaining as unearned. So every time you earn a portion of monies that were paid in advance because it was considered initially as unearned revenue, your adjusting entry will be a debit to the liability, unearned revenue, and a credit to the revenue. Liability down, revenue up. All right. The third and fourth types of adjustments are going to deal with accrual accounting. Our third entry is to accrue for revenue earned but not yet received. And the fourth and final adjustment is to accrue for expenses incurred or owed but not yet paid. And that follows accrual-based accounting. That is also one of the primary guidelines we follow under generally accepted accounting principles. We want companies to recognize revenue when it's earned, not when it's received or paid. And we want companies to recognize expenses as they are incurred, not paid. And that follows those two very important principles we talked about the other day, one being the revenue recognition principle, and one being the matching principle. Revenue recognition principle. We recognize revenue when it's earned. It is the completion of the earnings process that allows the company to report the revenue, not the receipt of the cash. So accrual-based accounting is the opposite of what is considered cash-based accounting. For cash-based accounting, companies only recognize transaction when the cash is exchanged. So revenue would only be recognized when they're paid, receiving the cash, and expenses would only be recognized when we actually disperse the funds, pay the expenses. And generally accepted accounting principles doesn't believe that tells as accurate a story as possible. So they require accrual-based accounting. Here is, has it been earned? Has the service provider or the seller of the inventory or product done their job? Yes, it's been earned, it gets recorded. Same thing with expenses. Has an expense been incurred? If the answer is yes, then that's when it gets recorded. We don't care whether the expense has been paid. So that is what creates the last two categories of adjustments. All right, C, we're going to talk about accrued revenue. So we want to make sure during our adjustment phase, during our last look, C, at our accounts, that the entire story is being told. So I want to make sure that all revenue earned is being reported. And so we take a look, and every once in a while, we realize, oops, we forgot to record some revenue. Maybe it's because the end of the month, maybe because we forgot to send out an invoice or a bill, whatever the scenario is. If we realize that there's been revenue earned that we have neglected to record, we need to do that. All right, and that is going to be our third adjustment. So we're going to adjust for all revenue earned but not yet received or recorded. So again, we're going to go to the journal because that's always the first part of anything we do once we make the decision, all right? Once we decide the adjustments we're going to record in the journal, and then we also want to post or update all the ledgers that are being impacted by these adjustments. The prepaid adjustments, I showed you those adjustments to the ledgers. Unearned revenue adjustment to the ledger. We're going to do the same thing with accrued revenue. So whenever you're accruing revenue, you're always going to debit some kind of receivable. It's an asset, money owed, and you're going to credit a revenue. So let's pretend we realize that we have a customer that we completed some work for, provided a service for, and we neglected to record the transaction on our books. We're going to accrue for that revenue now. Asset, accounts receivable up, revenue up. Revenue, remember, goes on the income statement and will increase our potential profit. The last and the final category of adjustments is similar to accrued revenue, except it's for accrued expenses. And it's very, very important that when we prepare financial statements, those financial statements tell the story during the right time period. So you want to match up all the revenue you earned against all the expenses incurred. So when you report net income or profit, maybe even a loss, you want to make sure you're telling the right information so that the users of the financial statements, maybe the internal users called management, the external users, creditors, and maybe investors or owners, get the best information possible. All right, so our last category of adjustments is to accrue for all expenses owed but not paid. All right, so maybe you have salaries. You pay your employees every Friday. The year ends on a Wednesday. You're going to pay them on Friday, but Friday is going to be January 2nd. Your year ends on Wednesday, December 31st. Those 3 days of salary, Monday, Tuesday, Wednesday, belong in the prior year. Thursday and Friday would belong in the January 2nd payday year. So you're going to accrue for those expenses for the 3 days that belong in the prior year so that you're matching up expenses with revenue. All right, so let's pretend we pay our employees $1,000 a day. We would owe them $3,000 Monday, Tuesday, Wednesday. We would debit salary or wage expense, $3,000, and we would credit a liability. We haven't paid it. We've got a payable. And when we actually make the payment of the payroll on January 2nd, you're going to debit salary expense for the remaining 2 days, $2,000. You would debit salary payable, $3,000 and credit cash for the total $5,000 you're going to send out. So again, you want to make sure that the picture you're telling, the story that ultimately gets reported in your financial statements, is as accurate as possible. All right, so those are the 4 types of adjustments. Prepaids, assets that become expenses, unearned revenue that have been earned, revenue we've earned but haven't yet recorded, expenses we owe but haven't yet recorded. All right. Once we're done with the adjustment phase and we have adjusted or tweaked all of our accounts, we've recorded the adjustments in the journal, we've updated all of the appropriate ledger accounts, we then prepare once again another trial balance. And that's called an adjusted trial balance. So that's telling us, hey, I took a look. I tweaked all of my accounts. I'm pretty confident that I've got all the revenue, all the expenses through the accrual adjustments. I've updated assets that have become expenses, and I've updated unearned revenue or a liability that's become revenue. So my balances should be fairly accurate at this point. So run another trial balance. Make sure you didn't make a mistake. And now we're ready to finally tell the story. And we tell the story by financial statement presentation. And it's very important that when we prepare financial statements, the financial statements are consistent with what is assumed to be the appropriate formatting. What do I mean by that? You always write the name of the company whose financial statement you're reporting first. Next, you report the name of the financial statement, income statement, statement of retained earnings or statement of owner's equity, balance sheet, statement of cash flows. Very important. So let's take a look at that first financial statement, which is the income statement. So I'm going to put the name of the company. You're going to put the financial statement. And then you show the time period, FYE, for year ended, December 31st, 2014. FME, for month ended, because we're showing the activity for a specific time period. You start with your revenue. Okay, so let's pretend this company had revenue of $100,000. You then list all of your expenses. Anything with the last name expense. I don't care what the first name is. Rent expense, salary expense, utility expense goes here. You get your total expenses. And let's pretend the total expenses were 70. And that would give you your net income or profit. Okay? On financial statements, we don't have debit and credit. We have total and subtotal. So let's pretend we had salary of 50 and rent of 20. Subtotal, total. You bring it over. So the columns don't mean debit and credit. The columns mean total and subtotal. This is a very simplified income statement. They can clearly be a lot more complex than that. Second, prepare your statement of net worth or owner's equity. All right, again, name of the company. Going to put your statement of owner's equity or retained earnings. Same idea. And again, it's going to be for year ended December 31st, 2014. Hi, I'm Professor Crawford, and this morning we're going to continue with our discussion about beginning financial accounting processes. Last time we met, our goal is to tell a story about what happens to companies when they make decisions. Those decisions are evidenced by what we call business transactions. And those business transactions need to be accurately reported or captured on the records of a company. So we start the process by examining these transactions, what happened, and ultimately the impact. And as we said yesterday, every business transaction must impact at least two accounts, your liabilities. Everything else belongs to the owners. In a small company, in a sole proprietorship, for example, a small business, that is called owner's equity. In the corporate form of business, we call that equity. We also discussed yesterday that when we analyze transactions, not only do we have to identify the accounts and what happened, but also whether or not we are debiting or crediting. Because when we begin to write down what happened, we record in what we call the journal, the book of original entry. And journal entries are always debit and credit format. Debit, whenever an asset goes up, whenever a liability goes down, or whenever your net worth goes down. Net worth goes down generally two times, when you have an expense and when you pay out profit. There are only 7 possible outcomes. Either assets go up or down. If an asset goes up, a liability or an equity account must go down. Or if you don't do anything to an asset, then the equity and the liabilities have to continue to balance. Everything we do in accounting is always predicated on what is called the accounting equation. Total assets, the good guys, the future value, is always going to equal the total debt or the liabilities of a company, plus what the owners have in value in that company. So assets, really, when we think of them, there are two groups that have claims on the assets. You have the creditors. Those are the people that lent the company money, and therefore they must be repaid. And then after the creditors are satisfied, after you have paid all of the profit to the owners, a drawing in a small business, a dividend in a corporation. Credits. Credits reduce assets, increase debt or liability, and increase net worth. And again, there are 2 times that net worth is increased. That's when the owner makes an investment and when we generate revenue. So after we're done making those decisions, we then go to the journal and we record the account that's being debited first and followed by the account being credited on the next line. We always indent the account being credited. We're always keeping in mind the accounting equation, always maintaining that equality. Once you're done with the journal entry, which shows the global or the big picture, we then go to the ledgers. And that's where we show the individual impact of a business decision on individual accounts. Every asset, every liability, every owner's equity or stockholder's equity account has their own individual ledger. We keep the asset accounts together in the ledger, then we go to the liability accounts, and then finally the equity. We call that posting or transferring information from the journal to the ledger. You've already made up your mind. You've already made your decisions. So you're merely transferring or posting the same information. So if you debited an asset in the journal, debit that same asset in the ledger. If you credit a liability in the journal, credit the same liability in the ledger. At the end of a time period, usually a month, we want to check to make sure that we didn't make a mathematical error, maybe forget to post something, put something on the debit side when it really goes on to the credit side, and we then prepare what is called a trial balance. And all a trial balance is, literally, is you take all of the balances